AT&T, ticker T, is currently trading at $18.43 and is down by about 4.31% since the last month, which is about $0.83. If we have a look at the maximum graph, we can see that the stock hit its lowest on 14th October 2022 of $14.99, which is the lowest since the last 28 years. Now, AT&T is working on bringing the capabilities of 5G networks across to its users in the near future, and therefore I believe that this is the perfect time to evaluate AT&T and see if it might be a good buy in the near future and a good investment for the next 10 or 20 years. To do this, we'll jump over to my stock analysis tool, where we will have a look at the 9-pillar analysis and find the intrinsic value using the Grams formula, revised discounted cash flow model, multiples valuation model, and the dividend discount model. We will then estimate the price of your investment in the next 10 years. If you have a look at here, we can see the income statement. We can see that the total revenue has decreased by 9.92% from 2021 to 2022 to $120 billion. The gross profit has decreased as well, and the net income has decreased as well by quite a bit. Operating cash flow has decreased by 3.65%. Investing cash flow has increased by 17% to negative $32 billion. Financing cash flow has decreased by almost 650% to $10 billion. Net cash flow has decreased by 253%, and free cash flow has decreased by 25%. We can see the balance sheet here. We can see the total assets, total liabilities, total equity, and shares outstanding. We can see that the dividend yield of T is currently at 6.02%, and cash per share per quarter is $0.28. We can see that the analyst's target price is $21.13 for the next year, compared to the current price of $18.43. Let's jump to the 9-pillar analysis. We want the 5-year P ratio to be below 22.5. T has its P ratio at 5.21, which is a good P ratio. We also want the 5-year profit margin to be above 10%. T has its profit margin slightly below 10%, but it's still not 10%, and therefore that's a no. We want there to be revenue and net income growth over the last 5 years. And as you can see, the revenue and net income have not increased over the last 5 years and have instead decreased, and by quite a bit actually, which is quite a red flag. We further want there to be decreasing shares outstanding, and from 2021 to 2022, T has increased its shares outstanding by about 1.12%, which to me is again a red flag, as the company is currently trading at quite a low value compared to its historical value, and therefore I think that the company should be buying back their shares and not issuing out more. Anyways, let's jump to the 6th pillar of this analysis, and that's the long-term liabilities over the 5-year free cash flow to be below 3. Now this metric is at 1.15, which is not bad, but ideally you want this number to be below 1, as when it's above 1, it means that the company has more long-term liabilities than what it can generate in free cash flow over the next 5 years. Next, we want there to be increasing free cash flow over the last 5 years, and as we can see, that has not been happening and it has been decreasing instead. We want the price to free cash flow over the last 5 years to be below 20, which it is, and this basically means that the company is undervalued. Finally, we want there to be consecutive dividend growth over the last 10 years. And as we can see, there has been quite a decent consecutive dividend growth, and this is disregarding the latest dividend cut. Now, as we can see, the 9-pillar analysis for AT&T isn't looking that great, but let's try to calculate its intrinsic value. First, let's apply the Grams formula revised. To do this, we plug in the earnings per share over the last 5 years and divide by the current yield on AAA corporations to get an intrinsic value of $7.91, which is quite different to the current trading price. But let's move to the discounted cash flow model. Here I plugged in the free cash flow over the last 10 years and calculated the average growth rate. I then looked at the analyst's growth rate, and I calculated the average growth rate, which I used to project the future free cash flow over the next 10 years. I then used the discount rate to project the present value of all future free cash flows, which I summed up and added any cash and cash equivalents, subtracted any debt, and got an equity value of $141 billion. I divided this by the shares outstanding and got an intrinsic value of $19.78, which isn't that different to the current trading price. Let's move to the multiples valuation model. Now, the only companies I think are comparable to AT&T is Virgin Communications and Frontier Communications. I took their current stock prices and divided by their earnings per share to get their PE ratios. I then averaged out those PE ratios and got an average PE of $10.75, which I multiplied by AT&T's current earnings per share, which is negative, and I got an intrinsic value of negative $11.94. Let's move to our final valuation, which is the dividend discount model. Here I plugged in the dividend yield over the last 5 years and calculated the average growth rate, which is at 1.3%. I then calculated next year's dividend, and using the WACC, I calculated the intrinsic value to be at $25.40. Now finally, let's evaluate our stock by averaging out the Grams formula, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an intrinsic value of $17.70. Now normally I would apply a margin of safety of about 10 to 15%, but according to our 9 pillars, which isn't looking that great, I will apply a safety margin of say 20%. And that gives us an acceptable price of $14.16. Before we finish this quick valuation, let's quickly jump over to my future value of investment spreadsheet, where I calculate the future value of your investment using historical data. Here you can see the percentage I plugged in for stock price growth, the percentage I plugged in for dividend growth rate, and the percentage I plugged in for inflation rate, all based on historical data over the last 10 years. Here we can see the stock price increasing every single year. Now, let's say we want to invest $500 this day at this current stock price. In 10 years, we would have $743, but in the present value, that would be only $592. So if you invested $500 in 10 years, you would have a 92% gain in the present value. Now let's say you were to reinvest the dividends you get every single year. This would result in your investment to more than double in the next 10 years. Now let's say you wanted to go a step further and you would invest $250 every single year. This would result in your investment to grow by more than 500% in the next 10 years. With this, I hope you enjoyed the video, and if you did, like and subscribe, and let me know down in the comments which stock evaluation you would like to see next. Also make sure to check out my previous videos, which you can see here at the top of the screen.